Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Morgan Stanley. To my surprise, I haven't analyzed this company at all in my channel. So you know what, seeing that their earnings are actually coming out on Thursday before open, guys, I figured, you know what, let's do it. Now, I'm going to be putting out this video at around Monday afternoon or so, and you're probably wondering, well, why Monday afternoon? I mean, the earnings are coming out on Thursday. Well, it's actually because, guys, the current share price for Morgan Stanley, it is $76.73. As you can see right here, it is down from a 52-week high of $109. So I figured before this thing goes any higher, maybe in the next coming days, let's actually analyze this company, and maybe you guys would probably like to invest in this company now that it's at this low. So with that said, let's get started with this analysis. Alright guys, we're going to come right into the dividend summary. Morgan Stanley does actually pay a pretty good dividend. Current yield at around 3.65%, which ends up being 70 cents per share for an annual payout of $2.80. Payout ratio, guys, is looking very good at 34.7. We're going to take a look at the payout ratio in regards to the free cash flow, because companies use their free cash flow to pay out a dividend. So we're going to be doing that. And their 5-year growth rate is also looking very good at a whopping 28.5%. That is amazing, if I do say so myself. Now, what isn't good though is that they've only increased their dividend for one consecutive year. So looking at the reason as to why this occurred is actually not as bad as you guys would actually think. The main reason is actually because as of 2019 to 2021, they essentially just kept it roughly the same at around 35 cents per share. Essentially, probably because of the whole COVID situation, they, instead of increasing it, they were like, you know what, we're not going to cut it, but we're not going to increase it. So that's essentially what I think that occurred. The reason is because of, again, COVID, why they didn't increase it in 2020. But for good news, guys, ever since July 28th, 2021, so roughly about a year ago, they increased it to a whopping 70 cents, essentially pretty much doubling their previous year, right? So in April 28th, you got paid 35 cents, and then July 28th, they increased to 70 cents. So that's actually fairly good. Now, unfortunately, if you would have liked to get this 70 cents per share, ex-dividend day passed as of April 28th. The payout date was May 13th, and they pay their dividends quarterly. Alright guys, coming into now the spreadsheet, we got the ticker symbol of MS for Morgan Stanley, market cap of $134 billion, PE, guys, of 9.76. This is the reason why I wanted to analyze this company, because this PE is actually looking like a $76 price might be very good buy right now, right? I mean, I just showed you guys at the beginning that the high price was at around like $109 or so. So again, this is essentially why I want to analyze this company. Also because this is actually a company that I used to own a couple of years ago, essentially when I started my dividend investing portfolio, and then I eventually just got rid of it. But, you know, it might actually be a pretty decent buy right now, so who knows what may happen. Now, looking further into this annual dividends per share of $2.80, this comes out to be, guys, almost $5 billion being paid out in dividends every single year in accordance to their shares outstanding. And once we take their 5-year average free cash flow and subtract the amounts paid in dividends from this 5-year average free cash flow, they're still left with around $3.7 billion. And if we do the same math with last year's free cash flow, by the way, I did change it. Instead of current, I put last, just because it's my OCD. I would prefer it last year. But nonetheless, the last year's free cash flow, if we do the same math, guys, this comes out to be $26.7 billion that they still have left. And if we take a look at these payout ratios, it's actually not that bad. In regards to last year's free cash flow, this is only 15.53%. And in regards to the 5-year average, it is a little bit high at around 57% or so. But this 5-year average free cash flow also takes into account the COVID free cash flow as well. The COVID year of free cash flow, which, spoiler alert, wasn't good. So that's essentially why we're getting at around 56%. But nonetheless, that's pretty much a quick overview of this company right here. Let's take a look at some fundamentals. And of course, we're going to start with the net income, as always, 5 years ago of $6 billion to 1 year ago of $15 billion. That's a pretty good increase, guys, of 146%. And in addition to that, they have been staircasing this up very, very consistently. And I like that, right? I like to see consistent growth when it comes to their profit metrics, right? So 5 years ago, it was 6.1 billion. 4 years ago, it was 8.7 billion. Then 3 years ago, it was 9 billion. Then 2 years ago, when COVID actually happened, it was almost 11 billion. And 1 year ago, it was $15 billion. Now let's take a look at, guys, their free cash flow, the most important profit metric for any company, because free cash flow, guys, it is essentially the lifeblood of the company. This is what they use to pretty much operate, right? They use this to grow the company, to make acquisitions, to issue that dividend, which they are issuing a dividend, to buy back shares, giving you guys a bigger piece of the pie, as well as paying down debt just to make sure that they don't go bankrupt, right? So cash flow goes into a whole lot of things. This is why you want this number to be consistently going up and, of course, positive, right? Now, unfortunately, this isn't looking too hot. One of them I could kind of understand, the other one I can't. So from 5 years ago, guys, they did negative $6 billion to 1 year ago of $31.6 billion. Now that is a big increase of 616% with a 5-year average of around $8.6 billion. Now, obviously, the elephant in the room here is the 2 year ago and the 5 year ago. Let's start with the easy one to explain. 2 year ago, COVID happened, right? End of story. COVID number, let's just ignore this pretty much. Now, the one that can't be explained, or at least the one that I can't explain just by looking at these values, right? It is essentially this 5 years ago value, because if we actually take a look further into what makes up the free cash flow, cash from operations, that's your capital expenditures, we can actually see that, well, their cash from operations was actually negative $4.5 billion 5 years ago. So this one is not a case that they had positive cash from operations, just their capital expenditures exceeded it. No. This is an issue that their cash from operations was negative. That is really, really bad, right? You do not want to see something like that. If their capital expenditures go beyond their cash from operations, this means that essentially they're reinvesting back into themselves, right? But if the cash from operations is negative, that's really, really bad. What caused this 5 years ago? I can't necessarily tell you. The one thing that I could maybe guess is that because this 5 year ago number was taken from 2017 or so, I believe interest rates were going up back then. I'm not fully certain, but if I had to guess, maybe that's it. Again, this is something for you guys to do a little bit more research on if you're interested in this. This 5 year ago free cash flow number, essentially why they did negative cash from operations, is something that you guys really need to take a closer look at if you're interested in this company. And now looking at the last profit metric, the revenue. Guys, 5 years ago of $38 billion to 1 year ago of a whopping $59.75 billion. That is an increase of 57.5%. Very, very similar, guys, to the net income, a nice staircase going up. So out of the three profit metrics, the one bad one is the free cash flow, right? And one of these numbers is explainable. One of them, I can't put my finger on it, but if you guys can figure it out, then by all means, leave it down in the comment section below. But in regards to the profit metrics, all of them are very, very good, except for that cash flow from 5 years ago. But again, if you guys are able to explain it, then by all means, these are looking very, very solid. Now let's take a look at some balance sheet numbers. First of all, total assets minus the total liabilities. Can the company survive a downturn in the economy, right? That is a major, major thing, especially now. So total assets minus liabilities. If the company can cover their liabilities with their assets, then we're essentially good, right? So currently they're at around $104 billion. And to their credit, they have been in the positive within the past 5 years and also increasing this as well. So all of this looks awesome as it stands. Average total assets around, look at this, guys, $1 trillion. Average liabilities around $928 billion. And doing this difference, we get $92.7 billion. Now let's take a look at the cash flow minus the liabilities. When we were doing the cash flow, I said cash flow is used to pay down their debts, right? So debts is part of the liabilities. What this simulates is, okay, if we take the cash flow year over year, and we take their liabilities year over year, can their cash flow cover their liabilities? And if not, which as you can see here, it's not, are they at least decreasing their liabilities? So unfortunately, this isn't necessarily the case. They're actually getting way more in the red. So they're taking on a lot more liabilities, even in cases that, like, for example, 1 year ago, their cash flow did fairly good at around like the $31.6 $1.6 billion or so, their liability still went even higher than that of their cash flow even 2 years ago when COVID happened and when they even had the negative cash flow. So this is actually really, really bad. And currently, guys, they're at a whopping $1 trillion in cash flow minus liabilities. So, you know, that's not ideal, but to be fair, they are able to cover their liabilities with their assets. And that's essentially what that is showing. Now, taking the average cash flow minus the average liabilities, we get around $881.8 billion in the red. Now let's take a look at, guys, the shares outstanding, a metric that a lot of people tend to not take a look at all. Because, well, this one is pretty obscure and pretty esoteric, right? Companies tend to issue shares because people don't really look at them, right? And the more a company issues shares, the less ownership of the company you have. That's essentially why you want the company to be buying back shares. Now, this is actually, well, it's not surprising, but it is fairly understandable. So 5 years ago, they had around 1.8 billion shares to today, guys, of 1.75 billion shares. Now, that is a small decrease on the 5 year of a little bit more than 1.75%. And from the previous year to the current year, this is looking at 1 year ago to today, they bought back around 0.9%. Now, what I said was surprising is that prior to COVID, they were actually decreasing their shares at a pretty decent amount, right? 5 years ago of 1.8 billion, then 4 years ago of 1.7, then 3 years ago of 1.6 billion, and then because of COVID, they issued a little bit of shares, right? They issued all the way up to 1.8 billion shares, but ever since then, they have been buying back ever since. So, you know, they had to issue shares because of the whole COVID situation. It was unprecedented, but nonetheless, they are buying back shares currently, which is, again, really good to see. And lastly, guys, when it comes to the cash and equivalents, they currently have, I kid you not, $136 billion in cash and equivalents, which is mind-boggling, with an average cash of around $84.5 billion. Alright, guys, now let's figure out if maybe we would actually like to buy this company at the current share price. So let's make some assumptions, low, medium, high, using 3 different factors into the future: revenue growth, projected share buyback, and of course the required rate of return. So coming over here to Seeking Alpha, guys, at the growth tab, we can see that the revenue growth year over year has been around 7.57%, and the revenue growth forward projected to be around 6.77%. So they're actually fairly close to each other, which makes this a whole lot easier to predict. So for the revenue growth, for the low assumption, let's go with 5%. For the median assumption, let's go with 6%. And for the high assumption, let's go with 7%. And now for the projected share buyback, we have seen that they are buying back shares at around 1% or so. So let's take that into account. So let's say 0.5% for the lowest assumption, right? 1% on the dot for the median assumption, and let's say 1.5% for the highest assumption. Now, with this, we get the target share prices, and the target share prices after that. I know what you guys are thinking. We'll get to that. So for the low assumption, we get a target share price, guys, of $78.98. For the median assumption, we get $82.16. And for the high assumption, we get $85.44. Now, let's take a look at the target share prices after that. And you guys are probably looking at this and just like, what? That is crazy jump. So for the low assumption, this is giving us, guys, $235.85. For the median assumption, we're getting $242.59. And for the highest assumption, this is now $249.59. Now, adding a margin of safety of 5, 10, and 50% to this target share price after debt, this brings it between, guys, $200.47 to $224.05 for the low assumption, $206.20 all the way up to $230.46 for the median assumption, and $212.12. Now, most of you guys are saying, 200? What? That is insane. Okay, so I said the same thing when I saw this, but reasonable explanation as to why this occurred. The way that we adjust for debt is we take the cash equivalents, we add the net debt, and then we add that to the market cap. If they have more cash than debt, then obviously this number comes up, and if they have more debt than cash, then this number comes down. Now you're saying, wow, they probably have a lot more cash than debt. Well, yes and no. If we take a look at, guys, at their balance sheet, scroll all the way down to the net debt right over here, we can actually see that, well, their net debts are in the negative. So currently their net debt on the on the last report one for the TTM, it is at a negative $250 billion, guys. That is essentially why you are getting that value of $235, $250, right? So you have a cash and equivalents of what, $136 billion, and then you add on top of that a negative value. Yeah, you're going to get a massive, massive jump when it comes to the share prices. That's essentially why this is happening. I know that Morgan Stanley's share price has never been above $109, but that's essentially why we're getting this for the target share prices after that. In my personal opinion, I think that these are not as accurate as these essentially. So personally, I would follow these target share prices not adjusting for debt, which, by the way, good news if anybody's interested in all three scenarios, this is an absolute buy right now. As you can see, even at my lowest assumption, we are still above the current share price of $76, around $2 or so. So you might actually consider this buying this. If you think that my assumptions are correct, that they'll grow 5% into the future and buy back shares at around 0.5%, you will get a required rate of return of 10% within the next 4 years if you buy it at around the $78.98 mark. But again, guys, all of this is based off of my assumptions, right? You guys might think different. You guys might think that they'll actually be making less revenue and that maybe they will issue shares instead. So if you guys were to actually change this to, like, let's say negative 1%, and you think they're going to issue shares at also at negative 1%, well, this essentially tells you that right now you would still want to wait up until they fall down to around $63 or so. Now, I personally don't think that will happen, but that is essentially why, guys, this calculator is available for all of you guys to have. So that way you guys can make your own assumptions. None of this was financial advice. It will never be. Every investment is the present value of all future cash flow, as I've said in every single video thus far, as well as, guys, every single thing that I have shown all of you guys when it comes to the charts. All of that is public information. So have this calculator. It's available for everybody. Make your own assumptions. It's in my calculators playlist. You go to those videos. It's in the description. You click on that link. You get to the discounted free cash flow, and you guys make your own assumptions, right? And on top of that, I'm also giving you a book value calculator for companies that don't have capital expenditures or even just to get a second opinion, as well as, guys, a reevaluation calculator for REIT companies and even a dividend tracking sheet. All of this, guys, all for free. All I'm asking for in return is like, subscribe, comment, help me grow my channel. Thank you so much for the 700 plus subscribers. I can't believe it. I cannot believe it. Thank you all so much for subscribing. Thank you all so much for the support. Thank you for the people who like. Thank you for the people who comment. You know, I really do appreciate all of you guys. So thank you so much. I'm happy to give all this out for free. All I'm asking for in return is something free in return. Help me grow my channel. Thank you so much. Now let's take a look at this dividend, guys, because, well, this company does pay a pretty good dividend. So if we were to put in 1 month's income at the current average US income at around $5,725 monthly, well, at the current share price, guys, which according to my assumptions is a good buy right now, this gets you 74.62 shares. And at the current annual dividends per share of $2.80, guys, this gets you $208.92 annually, $52.23 quarterly, and $17.41 monthly. Guys, anything above 200 or so for $5,725, I consider a pretty good return on investment, in my personal opinion, right? So the fact that we're getting this might actually be not a bad company to buy right now, honestly. I know I sold it before, but yeah, this might actually be fairly decent, even looking at it from a dividend perspective. So if you like what you have seen, and you like this dividend as well, then consider making your own assumptions and maybe even buying it. All in all, as I've said, I used to own this company. I like this company, honestly. And when I bought it originally, I didn't have this kind of free cash flow, guys. So I was essentially buying it out of whim. But now that I've seen this, I am 100% going to do more research, actually, just after I'm done with this video, as to why they did negative free cash flow 5 years ago. This one I understand. This one kind of bothering me. So I'm going to do more research on that, and I'm going to decide whether or not that is a reasonable answer as to why they did negative cash flow, and if it's reasonable, then I might consider buying it because that dividend is looking very, very good, and the current share price, according to my assumptions, is looking like a very, very good investment. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video, which we're going to be doing a whole lot of banks.